Hi, welcome to Carnegie. My name is Markus Almerud. I'm an analyst here at the bank. We're here today to talk about Elanders. Elanders mainly delivers solutions for contract logistics, but also have printing solutions. We have a fair value range of 145 to 155 Swedish krona. The investment case in short is that the company has transformed into a logistics provider from a printing group over the past 7 to 8 years, and logistics solutions now account for over 80% of sales. It has made 2 large acquisitions in the past couple of years, and this has positioned them to get exposure to structural trends in the logistics sector. The acquisitions and the repositioning have also allowed them to expand the margins. Cash flow is very good, and despite the repositioning, the share trades in line with levels when they were a pure printing group, that is before the transformation. So what is contract logistics and why is it interesting? Well, Supply Chain Solutions is a third-party logistics provider that manages all or part of their customer supply chains. Components and/or operations that they serve are often complex and lead times are short. The reason for the companies to use the services is flexibility, better efficiency, and lower cost. There are lots of mega trends that affect logistics, and we expect supply chains to keep diversifying over the next decade, for sourcing to move closer, for companies to find alternative suppliers to reduce risk, so-called second sourcing. These trends have been in play for some time now, but have been emphasized by the war in Ukraine and the pandemic. We believe that these trends will continue and that they will benefit logistics suppliers such as Elanders. Moving on to the drivers of the company. They made their first acquisitions into Supply Chain Solutions in 2014, but made a transformational acquisition of the German-based company LGI in mid-2016, doubling the company and taking supply chain to 50% of sales. Sales have since grown by 90% per year on average, out of which 4 percentage points is organic. And this means that acquisitions have accounted for about 85% of sales growth. A couple of words about the shorter term trends. Organic growth has been under pressure for the past year, partly because of freight prices coming under pressure in the beginning of 2023. What's important is that the environment has not gotten incrementally worse, and this means the growth rates are about to catch up. There are signs of recovery of printers and laptops at the end of the year, and there are a couple of large fashion customers in Europe that are ramping up during the first half. Regarding the margin, it has continued to expand on the margin despite the negative organic growth, and this bodes very well for when growth returns. The balance sheet. Firstly, cash flow is impressive. For the past 5 years, free cash flow per share has been between 25 and 45 Swedish krona per share, giving very high free cash flow yields. Secondly, net debt to EBITDA, which has been viewed by the market as an issue, is not as high as it seems, and must also be seen in the light of the good cash flow. The 2 latest mega acquisitions have been financed using debt, which is a strength in our view, and even after the acquisitions, pro forma net debt to EBITDA was 2.84 times, that's at the end of the year, which is not bad given that they just made a 1 billion krona acquisition. They also clearly cover the covenants. They also clear the covenants with a wide margin. In terms of valuation, the share trades in line with the level where it was trading when it was focused entirely on print. Since 2016, when it acquired LGI, it's been at a higher average level, but it's now significantly below that level. So in summary, Elanders is a company which has gone through transformation, has high exposure to structural growth trends, but where valuation is not reflecting that. It's trading at the levels where they were before the transformation. Thank you.